Welcome back to the JD Power AI and Insurance podcast, where we explore how artificial intelligence is reshaping the insurance industry in real time. I'm your host, Michael Vermillion. Today, we're diving into one of the most complex, volatile, and strategically important areas of P&C insurance, catastrophe risk. We're joined by two leaders who sit at the intersection of climate, capital, and technology. Terry McLean, co-founder and CEO of SageSure, and one of the fastest growing homeowners carriers in the catastrophe-exposed markets, and Paul VanderMarck, Chief Technology and Innovation Officer at SageSure, and previously one of the original leaders who helped build RMS into the global standard for catastrophe modeling. Together, Terry and Paul bring a unique combination of operational experience, modeling expertise, and forward-looking innovation. And today we're going to unpack how AI is influencing and not yet influencing the way our industry understands, prices, and manages catastrophe risk. Terry and Paul, thanks so much for joining us today.
Good to be here. Thanks for having us.
Terry, why don't we start with you, just for kind of background for listeners who may not know the full SageSure story. Can you walk us through the mission, who you serve, and what differentiates your approach to managing catastrophe-exposed risk?
Yeah, it's been an interesting journey here at SageSure. We really got going writing business in 2009. So it's been 16 years that we've been doing this. And we really went into places where everybody else was running away. We showed up at a time when there was a lot of national carriers pulling away. And we've been writing business and growing at a decent pace, but from a base of zero over the last 16 years. And so it's been quite the journey. We focus on going to places where the markets need us most. And so that usually looks like hurricane exposed areas, wildfire exposed areas. And earlier this year, we closed on the acquisition of Giovera, an earthquake focused insurer. So we go do the stuff that a lot of people don't want to do.
And Paul, how does the technology platform reinforce the model?
Good question. So we're committed, and we have been since the start of the company, to build all of the software that we operate the business on instead of licensing systems off the shelf from commercial vendors. And it's simple, really. We believe we have to do things differently than others to build a successful business in these markets we operate in. You can't build a differentiated business on the same technology that everyone else uses. And we operate in markets that are dynamic. They change significantly and frequently, and we need to be nimble as a business in how we respond to those and the role we play in those. And we can't do that if every time we want to change something about the capabilities our people have internally, the capabilities we put in the hands of our producers and our policyholders. If we have to get in line with a vendor and hope they'll agree to make a change, that we can't operate at that pace and be successful in building the business that we want to build.
All right, so let's talk a little bit about the kind of the current reality of cat risk. So Terry, cat markets today look very different than they did 10 to 15 years ago, from climate volatility to inflation to reinsurance constraints. What stands out as maybe the biggest shift in the risk landscape?
Yeah, that's a lot to unpack in that question. Hard to boil that one down. I mean, it's been interesting journey. If you go back, I mean, I'm just going to rewind 20 years ago because it's irrelevant. You had 2 years of major hurricane activity in 2004 and 2005, 4 landfalling hurricanes in 2004 in Florida, and then Katrina, Rita, Wilma in 2005. The market hardened very fast and it softened very fast. But that was over what looked like aberrational hurricane activity. And we then had 10 years of very mild hurricane activity from 2006 through 2015. And in 2016, and then Irma in 2017, we started seeing elevated levels of catastrophe activity. So you had this depressed period of 10 years, and then we just had 10 years of a lot of activity, hurricanes, now wildfires, not earthquakes, but we've had lots of severe convective storm activity. You had the winter storm Uri hit Texas in 2021. So just an immense amount of activity, inflation happening at the same time. And after a bunch of years of reinsurers making money, they lost a lot of dollars. The retro market lost a lot of dollars, and they decided prices had to go up. Their capital levels went down, And so price had to go up dramatically. So what we saw over the last 4 to 5 years is for a lot of consumers, prices have doubled, and that's pervasive in a lot of areas of the United States because of catastrophe activity, because of reinsurance pricing going up and reinsurance pricing going up because of elevated catastrophe activity. So you put inflation in the blender along with that, and then you have other loss trends. We're seeing fire trends going up adversely against us. So when you put all that together, that is tough times for consumers. So that's the bad part of the last 5 years. The good news is we've hit a top, and in most places, prices have largely peaked in 2025. So that's not true everywhere. We're seeing pockets like the Northeast where it looks like prices have to go up further. California wildfire is still, the jury's still out on that one, but maybe pricing has peaked. And in places like Florida, prices have started moving downward. So it's been a rough landscape. It's been a rough ride. It's been challenging for consumers who've seen their prices go up. But in summary, it looks like we've hit the top, at least in this cycle, in terms of pricing.
Okay, so then to build on that, let's just talk a little bit about the evolution of cat modeling. So Paul, cat modeling started with meteorologists and wind engineers. How has the science evolved, and where is AI already improving the way we understand climate, hazard, and vulnerability?
So it's interesting. I think people don't realize this or forget it. I would argue that cat models were actually the first class of AI that the insurance industry adopted commercially at scale. And AI tends to mean whatever the current version of AI is in people's minds whenever you talk about AI. But if you rewind to the late 1980s, the 1990s, AI and really the first incarnations of AI were expert systems, is the term we used. And that's what cat models were, or are, is the encoding of the logic that experts in various fields would use to make decisions, in this case about how to assess the risk to an individual building. And you could then replicate that logic at scale rapidly when coupled with all the necessary data. And so that's what cat models were built to do, is to replicate the expertise of engineers and scientists and so forth to estimate natural catastrophe risk. So today we talk about AI, and we typically mean in the current day, we generally are referring to generative language models, but not that many years ago we were talking about deep learning and computer vision, and a few years before that it was about machine learning. So those are all different classes of models, and each of them have contributed to catastrophe modeling getting better. I don't think there's a near future in which you'll see the structural form of cat models change and go away and be replaced magically by an LLM. Think of it more as the capabilities that exist today help the modelers build better components of these models. I think for us, in a way, what's most interesting is how we're able to adapt the models for our own use and in the role that AI plays in that. And to give you an example, models have always been built as industry average models. It's a fixed model. Insurers put their data in, and the outputs vary based on only the differences in what properties you insure and their characteristics. The reality is that there are a lot of other things that are different. The coverages you provide in your policy forms are not all the same. The way you handle claims is certainly not the same across carriers. And so the output of the models is generic and industry standard. The reality is different than that. And so as a user of the models, we can use AI now to enhance our view of risk and adapt the models better to reflect our business. And a really great example of that is what we do post-event, which is where the models, ironically, have always been weakest. So the models are designed to give you a stochastic view of risk over time. The time people most want them to have the most intense need for good output is when there's a hurricane or there's an earthquake, and everyone wants to know how many claims are we going to have, what are our losses looking like. And the models classically have been weakest at that point. That's not actually what they're built to be good at. And there's a lot of uncertainty in every event, the idiosyncrasies of every event and so forth. And so we've built internally a proprietary AI framework where we take the cat models and the representations of an event immediately post-event, but we train the model continuously on our own claims data, which is something nobody else has and is unique to us and our experience. And so on a real-time basis in the days and weeks post-event, we're building our own model of how many claims we expect, what severity of claims, what total losses. And that's based on a whole series of structured and unstructured data. It's the property data, it's the cat model output, it's also all the unstructured notes in the FNOL transcripts and submissions we get from customers when they file a claim that describe the nature of loss and so forth. So we bring all that together with actually various kinds of AI submodels into a model. It gives us a much better view than we've ever had before of what we're dealing with after an event, which in turn helps us serve our customers better and give our reinsurers a better understanding of what our loss expectation is and so forth.
Okay, terrific. Let's talk a little bit about pricing and AI. So there's hype about AI transforming pricing, yet cat rating plans remain driven by long-standing models and regulatory structures. Why hasn't AI meaningfully shaped pricing yet? And what would need to change for regulators to accept more AI-driven approaches?
Yeah, it's a great topic. I mean, historically, regulators want to know that they can see direct causation between an underlying loss pattern and how much people are charging. They want to see the data. They want to see that these losses have actually contributed rather than some black box over there. And I don't think it will never happen. It hasn't, from what we understand with regulators, it hasn't happened yet. We haven't seen anybody on the property side use a black box model that can't be explained, where you can't attribute the underlying loss experience and say, I want to charge this rate because I think this customer is going to have more claims. They want evidence that has in fact happened. So that's the main reason we haven't seen it is AI. We haven't seen any algorithm. Certainly there are things like credit scoring, insurance scoring that exist in most states where they're using some algorithm and they say, look, our algorithm is proprietary. We'll share it with you, regulator, and we'll show you these people have these scores and they tend to have more loss frequency than somebody else, for example, and those get shared. I think that will eventually happen where somebody will develop a model. Maybe it's somebody like a rating agency, insurance scoring vendor, somebody of that nature. But we haven't seen it yet. So, and certainly on our side, we don't think that's the great frontier. The use of AI is not the biggest thing that we think we can use AI for, nor do we think it's a big opportunity for winning in our business. Eventually, we expect it to be pervasive, but that should be a long time in the future.
Paul, you spoke earlier about industry average models and the fact that SageSure is now developing kind of your own internal differentiated view of risk. So I just want to double click on that for a second. Why is that so important in cat exposed markets, and how does AI strengthen that capability?
Terry mentioned earlier the run through the last couple of decades of activity. I'd say Katrina in 2005 was a real turning point in this industry. We've spent the better part of a couple of decades getting buy-in in this industry to the use of cat models and how they improved over legacy actuarial sorts of techniques. And there was a certain degree to which people then just outsourced their understanding of risk to the cat models. And in Katrina, there were so many surprise losses of various sorts, the flooding in New Orleans, the severity of damage to commercial properties, all sorts of examples that there's a real reckoning in the industry of people realizing, look, we can't just outsource our view of risk, which is one of the most fundamental things we do in this business, to a model. The model is a tool. The tool informs your management of risk, but you as a business ultimately have to have a view of risk and be responsible for that and price business accordingly, buy reinsurance accordingly, manage your portfolio accordingly, and so forth. And so that's certainly a big part of our philosophy in running the business is we're responsible for understanding the risk we take on, using the models as tools to do that. And like I said before, one of the most important parts of that is recognizing that our portfolio will not generate the same outcomes in an event as somebody else's portfolio. We pride ourselves on being rigorous underwriters. We've invested hugely in building a claims organization that's geared toward handling property and specifically property catastrophe losses and doing it really, really well. And our results in a catastrophe event don't look like somebody else's with the same general amount of premium in the same area. And so a lot of our work is how do we adapt the models to reflect our business and realistic expectations of how our portfolio will perform. And then there are also topics like climate change and the questions of how is climate change, for example, impacting hurricane activity. And I think the modelers themselves have taken a different approach on that than they have historically to other things, which is not saying they have an answer and a singular view that is in the models, as opposed to saying there are a range of assumptions that can be made. they're playing a role of, to some extent at least, helping translate some of those possible assumptions into different outcomes. But it's on us ultimately to have a point of view on the horizon at which we're concerned about the impact of climate change, what sort of actual impact we believe it will have, and how that factors into our view of risk. And to what extent that's relevant relative to the year-to-year volatility in activity, which is, of course, much greater than any long-term trend. And so that's on us. And we employ teams of people with expertise and PhDs in these various fields and adapt the models as we need. And that's a core part of how we do business. It's what our carrier partners expect of us. It's what our reinsurers expect of us. And it's we think it's essential for operating the markets we're in. And AI, to your questions about AI plays an important role in the models we build that help us interpret the cat models and adapt them to come up with that view of risk.
Okay, before we finish up, let's touch on reinsurance. Paul, you mentioned reinsurance. So reinsurance has become more expensive and selective. How can AI improve segmentation and better portfolio intelligence help carriers place smarter treaties and demonstrate portfolio quality?
It's an interesting question today, to the extent that reinsurers are relying on information. They're primarily relying on the information provided by the carriers and what the models say about it. And to Paul's answer and commentary about the model's evolution and individual carriers' view of risk, the individual view of risk of SageSure or one of its carriers really doesn't generally make its way to the reinsurance market. The reinsurers have their own views of risk, and to the extent they're adopting AI, certainly we are hearing about reinsurers who are doing things to augment their data and get additional information. So that's unique to each reinsurer. We're not seeing anything pervasive across the industry where all reinsurers are adopting a single view of, say, some AI model or things of that nature. So at this point, we're not seeing it significantly.
Okay, terrific. So to close out these conversations, we like to look forward, right? So I've actually got a 3-part question here. So we'll just take it one part at a time to make it easier. So part one would be, looking ahead, what AI-driven advancements do you think will most meaningfully change how the industry understands prices and manages catastrophe risk?
I think the answer is claims. But Paul, do you agree with that? And would you? I mean, I think that would be yours to give an answer to, because you're much closer to the individual. But I think the simple answer is in claims. But I'll turn it over to Paul to dive into that one if he agrees.
Look, AI is clearly going to impact every part of our operations over time in different ways, but claims is top of the list. And I think, Michael, if you think about it from a customer perspective, well, even more broadly, catastrophe events historically are when insurers have fallen over. It's a time of peak load on people, on systems, and lots of things have gone wrong historically across this industry when there's a large event. It's everything from the customer who's, dealing with something tragic they've never dealt with before and doesn't know where to turn, and their insurer is not present in that conversation or that experience early, to them turning to the carrier and often waiting on the phone for hours on hold because there aren't people available to talk to them and take FNOL, and going to a black hole of not being able to contact someone and find out what's happening with their claim, and it taking forever to get resolved, all the way through to carriers who are deploying auto insurance adjusters from Montana to go settle hurricane claims in Florida, and getting to a point of saying, look, we just need to settle these claims. We're underwater, write the checks, get it done. And ultimately reinsurers saying, wow, that event cost a lot more than we ever thought it was going to cost. And what you told us an event like that would cost. And all around, it's a mess. From the customer experience through to the outcomes of the event, a lot of leakage along the way, and contractors making excessive margins and so forth. And so there's a future we're working toward as specialists in catastrophe risk that's very different, with AI playing a role in making all those things better. And to give you a few examples to make it tangible, we've recently deployed voice FNOL using AI agent so that if, among other things, at times of peak demand after a large catastrophe event, we're not dependent on scaling across people only. We have lots of other mechanisms, digital mechanisms for people to file claims, but voice FNOL helps. Something we've built that's a proprietary capability recently is we built a computer vision model where we can look at aerial imagery and detect damage and classify damage. After a hurricane, when we might have 100,000 or more policyholders exposed to high winds, we commission aerial imagery to be flown as soon as the airspace clears after an event. So a couple days post-event, we're getting images in. We can now run those models essentially in real time against that imagery and identify every policyholder who has visible damage to their house, classify the severity of that damage. And for anybody that we haven't already heard from, often people are still evacuated at this point in a major event, we start making outbound contact to those customers. And we have great stories of what an incredible experience that is for somebody who's in that state post-event and gets a call from their insurance company, even if we have bad news about their property that they don't have yet, to be able to say to someone, look, we have certainty of what's happened to your house, we can send you imagery, we can deposit advance funds into your bank account, get you temporary housing, and help you out. That's a pretty incredible experience for somebody when their insurer shows up for them and is helping them in that time of need. And then all the way through to the handling of the claims. There are numerous things we're doing to take rote tasks out of the hands of adjusters using AI and automation so that adjusters can spend their time doing the things that are unique and truly value added, so they can get their work done faster. We don't need as many people to handle claims, bring more expertise to bear more quickly, and help ultimately get claims resolved more quickly with good outcomes. And so that's a quick sample, but we're working on things across that whole life cycle of claims that for every year that goes by, we get better and better, certainly as a company, and I think as an industry, in applying different types of AI to enable those sorts of capabilities.
Right. Well, Terry, the second part of the question was going to be how you see AI kind of reshaping the customer experience, especially when it comes to claims. Paul did a great job of walking us through that. Anything?
I answered your question for you already, but Terry may want to add more to it.
Yeah, sure.
Yeah, I mean, I don't have anything to add on that other than we're actually doing some of these things, and we had some experiences both in the hurricanes in 2024 in Florida, and we had experiences in following up on wildfire activity using aerial imagery. The actual role of AI in some of those it's early, but it will improve and it will increase. In our view, it will be increasingly ready for big events. I mean, I don't know. I think there's a question of if, it's a question of when we have the next big hurricane hitting Florida or the Southeast or the Gulf or the Northeast. And we think we're going to be dramatically more ready than we were, say, in 2023 to use that kind of technology. So it's pretty exciting time, and we're going to be able to serve customers better. We're going to be able to do it with less people, and that's an exciting role for AI to play.
And then just to finish up, and any advice for leaders who are thinking about what we just talked about, just in terms of what they should start doing now to prepare for that future?
I'll let Paul. Go ahead.
Sure. Well, building off the examples I just shared, I think what's important in applying AI in this time in our business is not getting too caught up in big grand visions, as opposed to tackling real concrete problems and working iteratively. And so what I just described, I can already paint what sounds like elements of a grand vision coming together on things we're already doing in claims across the whole life cycle. Honestly, that's not how we got to where we are today. We got to where we are by going after very specific needs. So we built a model to classify damage, identify damage from aerial imagery, because enabling proactive outreach to our customers was important to us, and that was the only way to possibly do it efficiently and at scale. We deployed voice FNOL because it was a logical thing to do to go solve that problem. We've built automation into other elements of the claims process. We've built the models I described earlier, all as individual efforts. Over time, you find the ways to stitch them together, and they start to build and create value as a whole. But I think we'd still be at the drawing board talking about designs and plans if we were working on big grand vision and trying to charter a big project to go after it, as opposed to having smaller teams go work iteratively on very tangible problems and make progress, get wins on the board, deploy things into production, and then move on to the next thing.
Yeah, the only thing I would add is, and it's really similar, the other side of the same coin is, it isn't going to solve all your problems immediately. And so to Paul's point about iterating, absolutely, you got to get in the game and try things. And some of them, I mean, like we've experienced, simply aren't ready. And over time, they'll be increasingly ready, and you need to be in position to try the things and be positively surprised. But certainly, I would say so far, we've been more negatively surprised than positively surprised at the things that actually can get done effectively and quickly. It takes a lot of calibration. It takes a lot of failure before you get to the things that actually work. So stick at it, but don't expect it to solve all your problems overnight, because it's not going to.
Well, Terry and Paul, that was terrific. Thank you both for joining us today.
Thanks. Great to be
Thanks
here.
for having us.
Your perspectives highlight how rapidly the cat landscape is evolving and how essential it is for carriers to build stronger views of risk, smarter portfolio strategies, and more resilient technology foundations. AI may not be fully shaping pricing yet, but it's already transforming how we understand hazard, manage capital, and serve customers after an event. For our listeners, if you enjoyed this conversation, be sure to follow the JD Power AI and Insurance podcast for more discussions with industry leaders who are redefining the future of insurance. And as always, you can find additional insights, research, and upcoming events at jdpower.com/insurance. Thanks for listening. I'm your host, Michael Vermillion, and we'll see you next time.